What's up everybody, I am Jaspreet Singh, and now with the Federal Reserve Bank raising interest rates, buying a home just got more, well, expensive. The Fed is raising interest rates to fight inflation, and they're not so subtly hinting that we are going to see more significant rate hikes in 2022, which means mortgage rates are going to get even more expensive. So now, if we're in an environment where home prices have been growing at record-breaking speeds, and now it's going to become even more expensive to borrow money to buy that home, what do you think is going to happen to home prices? Actually, hold that thought because the answer isn't so simple. Bill Gross, the billionaire investor and founder of the investment company PIMCO, gave an interview where he said that either the Fed is going to break inflation or they're going to break the housing market based on their policies. Essentially what he's saying is that the Fed has to raise interest rates in order to fight inflation. And when you raise interest rates, it makes buying a home more expensive. So the question is, what's going to break first? Is it going to be inflation or is it going to be the housing market? Because if the Fed has to raise interest rates significantly to fight inflation, you might end up crashing the housing market before inflation gets fixed. I've given this example before, where you borrow $500,000 to buy a home and the different costs for your mortgage depending on what mortgage rates are. But what I want to do today is actually build on top of that example. So just going back to this, assuming that you can get a 3% mortgage to buy this $500,000 home, your monthly payments are going to cost you about $2,100 a month. This is where we were in 2021. But if you got the same $500,000 to buy this home at a 5% mortgage rate, now you're not paying $2,100 a month, you're paying $2,700 a month. This is pretty close to where we are right now. And if you got the same $500,000 at an 8% mortgage, now the same $500,000 is going to cost you $3,700 a month. If the Fed has to significantly raise interest rates, an 8% mortgage is not out of the question. So clearly, buying the same home is going to depend on what your mortgage rate is, right? Buying the home at a 3% mortgage is much more affordable than at an 8% mortgage. But what happens now? If mortgage rates go up, you might say that home prices will fall because the person who could buy it here isn't going to be able to afford it here. So now naturally, if you could afford a $500,000 home here, now if mortgage rates go up to this, you're not going to be able to buy that home anymore, which means that the demand to buy homes will go down, which would push home prices lower. So let's talk about this for a second. If you have a monthly budget of say $2,100 a month, what kind of home can you afford then? So if we start dissecting this backwards, you can really start to see the effects of higher mortgage rates on the housing market. Because assuming you have a monthly budget of $2,100 a month and mortgage rates go up to 5%, well, you're not going to be able to afford the same $500,000 that you could here. Now, you can only afford a home that allows you to borrow $400,000. And if mortgage rates go up to 8%, you'll only be able to borrow $290,000 to be able to support your $2,100 monthly payment. You can start to see that if mortgage rates go up and your budget doesn't change, your monthly budget, well then the size of the home that you can buy is going to have to go down. So now the real question is, what's going to crack first? Is it going to be inflation or is it going to be the housing market? Because if the Fed starts to significantly raise interest rates and inflation doesn't go down, eventually you're going to hit a point in the housing market where people are going to say, I can't afford these homes anymore. And we're already starting to see that because home prices have gone up so much. People have been borrowing more dollars, but they've been able to do that thanks to the help of low mortgage rates. So now we have these very high home prices. We have inflated home prices and mortgage rates that are on the rise, which means that that same home is going to be significantly more expensive just because, well, the mortgage rate is more expensive. And if inflation doesn't start to crack, but mortgage rates keep going up, well, then that could crack the housing market because eventually people are just going to say, I can't afford these crazy prices and crazy mortgage rates because now it's just way exceeding my monthly budget. Now, a couple minutes ago, I asked you what would happen to home prices if mortgage rates went up significantly. And the reason why I said the answer is not so simple is because you can't just look at mortgage rates and home prices in a bubble. You have to look at it relative to the entire economy, and you have to look at it relative to what the Federal Reserve Bank is doing. Up until the time of me recording this video, the Federal Reserve Bank has said time and time again that they want to raise interest rates to fight inflation. But the question really is, how much and how fast are they really willing to do that? I mean, they say that they're willing to more aggressively raise interest rates to fight inflation if they need to, but what is that need really going to be? I mean, we're already seeing inflation rates at the highest that we've seen in decades, and the Fed says that our economy is strong enough to withstand higher interest rates, and the Fed says that our markets are ready to withstand higher interest rates, but the Fed really hasn't raised interest rates that significantly yet. They just keep saying that they will raise interest rates in the future. They say that they're going to raise interest rates multiple times in 2022, and they're saying that they're willing to raise interest rates even more drastically if they need to. But the real question is, what is that need going to be? I mean, if we don't need to yet, then what is that need really gonna look like? Because to me, I would think that the inflation has already gotten out of hand. But what do I know? I'm just a random guy on YouTube. This is why it's so hard to predict what the Federal Reserve Bank is gonna do, because if something comes up in the economy or the world between now and the future rate hikes, the Fed could use it as an excuse to stop raising rates. Like maybe this pandemic makes a resurgence, or maybe we see more war or more crisis happen overseas, or maybe we see something happen in the economy. These things could slow down the Fed's rate hikes, which would ultimately affect the housing market. But in any case, we've already started to see a drop in mortgage applications because people are less interested to buy a home when it's more expensive to buy a home than when you have a discount because of lower mortgage rates. This is why you've been starting to see more revisions and housing sale predictions for 2022, because everybody says that these higher mortgage rates are going to make less people interested in buying a home, which is why people are saying that we're going to see a slowdown in the housing market in 2022 because of the higher cost to buy a home. Now remember, there's a difference between a slowdown in the housing market and a housing market crash. A slowdown means less people are buying a home now than before, and a crash means that home prices are going down quickly. And this brings me to the next point that I want to talk about, which is, are we going to see a housing market crash because of these higher interest rates? It depends what cracks first, inflation or housing prices. The Fed is now starting to raise interest rates to fight inflation. Now, this small rise in interest rates probably isn't going to crack the housing market. But if interest rates continue to go up and inflation doesn't go down, well, you're going to see less people wanting to go out and buy a home because, well, it's going to be a lot more expensive to buy a home. And it's just going to depend on how fast and how aggressively the Fed has to raise interest rates relative to how strong the economy is. Higher interest rates affect more than just the housing market. I mean, when you have higher interest rates, credit card debt becomes more expensive and business debt becomes more expensive. So it becomes a lot more expensive to live and operate, which means you could see a slowdown in the economy. Now, the Federal Reserve Bank has said time and time again that our economy is robust and it can handle higher interest rates, but we don't really know if that's true until we see it happen. And so if the Fed starts raising interest rates and the economy slows down, well, that means that people would start losing their jobs. If people start losing their jobs, then they're going to have a tougher time making their mortgage payments, which will ultimately hurt the housing market. But if the economy continues to stay strong and you continue to see wage growth and people start to make more money from their jobs, well, then that could also support higher home prices, even though interest rates are going up because, well, people are making more money. But there's a lot of ifs there. And so you have to pay attention to each one of these things, because it's not just what's happening to mortgage rates, it's what's happening to home prices, what's happening to mortgage rates, what's happening to the economy, what is the Fed doing, what's happening overseas. All these things come and play a part in the housing market, and we have one big advantage in the housing market right now: equity. The reason why our economy and our housing market is nothing like 2008, at least yet, is because of equity. So right now, let's assume that you bought this home for $500,000 6 months ago, a year ago, a few years ago. If you bought this home for $500,000 more than, say, 6 months ago, you have naturally some built-in equity in your home, because home prices have been going up pretty much across the board. I mean, in 2021, we saw home prices grow by almost 20%. So if you've seen 20% appreciation in your home over the last year or so, well, that means you bought this home for $500,000 and now the home is worth $600,000. Now, this is almost like invisible money that's in your home, and if you lost your job, if you can no longer make your payments, but you're not going to go into foreclosure, because you can sell your home and walk away with $100,000 in your pocket and downsize and do whatever you need to do. You have built-in equity into your homes. We didn't have that in 2008, because in 2008, it was the complete opposite situation. People bought homes for $500,000, and now the home was worth $400,000. So you couldn't refinance, you couldn't sell, the only option was for it to be foreclosed on if you couldn't keep making the monthly payments. And you also had a lot of people getting adjustable rate mortgages with a bunch of really bad lending. So the first advantage that we have right now is people have this built-in equity. If you bought a home more than 6 months ago, chances are you already have some built-in equity in your home, which is a good thing for the sustainability of the housing market, which is a good thing because that prevents foreclosures. If things start to turn, that means that you'd see home prices start to go down, this equity will start to go down, and chances are we'd also start to see more adjustable rate mortgages start to pop up. So those are the things that you want to pay attention to over there, but you also want to pay attention to one last thing. You have to pay attention to the supply and demand in the housing market, because at the end of the day, as long as you have more buyers than sellers, that's going to keep pushing home prices up. But if you have more people wanting to sell their home than people want to buy their homes, that's going to push home prices down. Now, I didn't do good in my economics class, so these type of demand and supply charts always scare me. But let me go over what's going on. So on the demand side, we have had a massive amount of demand of people wanting to buy a home because you had the low mortgage rates, people were moving out of cities, people wanted to work from home. So you had a massive amount of people that wanted to buy homes and take advantage of these low mortgage rates, while the supply of homes have been artificially very low. Part of the reason is because builders haven't been able to build homes, they can't source materials, it's harder to find labor, it's more expensive to find labor, it's more expensive to find materials. So the supply of homes has been very low, and on top of that, add in the pandemic and having a tough time finding people that are willing and able to work. So we've had a very low supply with a very high demand. These two factors together have pushed up home prices. But now what we're starting to see happen is demand is starting to slow down. It hasn't gone away, but it's starting to slow down. We still have high demand, but it's starting to slow down because home prices are becoming more expensive, mortgage rates are more expensive, and we're starting to see the supply of homes trickle upwards. People are building more homes, we're starting to see more homes start to finish their construction, and so we're starting to see this type of convergence. The question is, what's going to happen next? If mortgage rates go up significantly and we start to see demand of homes start to go down even more, well, that's going to affect the demand side, but you also have to look at the supply side. If builders can start constructing and building more homes faster, well, then we're going to start to see a flip, because then you'll start to see more supply than demand, and that's what pushes home prices lower, because now you have more ability for people to go out and buy homes, and that could push home prices lower. Now I say could because, again, you have to look at all the other factors that I talked about, but these are the two factors that you want to pay attention to when it comes to the demand, how many people are buying homes and are able and ready to buy homes, and how many homes are available for sale. This has been one of the biggest struggles in the housing market, that we've seen a small inventory of homes, some of the lowest inventories of homes ever, which is why you've been seeing so many bidding wars, because everybody's trying to fight over just a few homes that are available for sale. So you like a home and then the next day it's gone because there's not that many options out there on the market because you have such a low supply. So if supply starts to go up while demand is going down, then that could start to flip the housing market. Again, to trigger a crash, you would have to see the equity go away. Now, if you'd like to stay on top of this type of finance and business news, I know it can be really hard to read all the financial news sources. That's why I like to break it down here on YouTube. But I also created Market Briefs. It's a free financial newsletter where our team breaks down what's happening in the finance and business world every single day. It's a free newsletter. You can read it in just a few minutes every morning, and it's a lot of fun to read. I promise you're going to look forward to reading this newsletter every single morning. So if you want to join Market Briefs for free, you can go to marketbriefs.com and join our free newsletter, or I'll also put the link down for you in the description below. If you enjoyed this video, here's a video on what every buyer and seller needs to be aware of right now. And while you're at it, if you want to subscribe to Market Briefs, my free newsletter, all you got to do is click that button below. Thank you for watching, and as always, keep hustling. This war that's going on overseas is going to increase inflation, which means it can affect mortgage rates